Hi, my name is Christina Heimstead, and I'm here to talk about money as a tool. This week I wanted to talk about new tax initiatives or other ballot-related items, given the fact that we're getting closer to election season here. Important to register to vote for things like this. So I think it's important to talk about taxes and how they impact everybody financially. In particular, I'm going to focus on some of the more local initiatives, i.e. California, as well as things related to housing. I'm probably a little biased myself, given that I'm in real estate, so it is what it is. So first, what I'm going to talk about here is Prop 5. Prop 5 is an amendment to Prop 13. Prop 13 came around in the 70s to help homeowners stay in their homes back in the day. It was your property taxes would change based on your current assessed value of your home. And at the time of purchase, you buy a home, you account for your property taxes, move on. Well, if you were buying in a neighborhood that was up and coming and growing and increasing in value year over year, your property taxes would aggressively increase proportionately. So a lot of senior citizens ended up being pushed out of their homes as a result of this, because their taxes just continue to grow. So Prop 13 came about to help combat that. So if you were over the age of 55, property taxes were now based on the assessed value at the time of purchase. On average, they go up by 2% year over year. So they do go up, but very incrementally. And given that the Fed's inflation target is 2%, hopefully that means that they're going up more or less in accordance with that. But the other thing that they allowed a lot of people to do is, for example, empty nesters who, maybe bought a home with the intent of raising their kids and no longer have kids, don't need to live in the perfect tract home or what have you, and want to sail off into retirement, move to the beach, do something else. It also allowed them to move their property tax base. For instance, if somebody bought a home for $1 million, at the age of 30, if we could all dream to do such a thing, take that. Say your home is now worth, you bought it for $1 million, so you're paying maybe, 30 years later, say you're doing this at 60, and your home is appreciated greatly to, we'll say $5 million hypothetically for the sake of numbers. You can sell your home for $5 million, move into a new home that was $5 million or less, and carry over that existing property tax base, whatever that $1 million property tax base has gone up to, probably around $15,000 a year. Generally, it's just north of 1% of your purchase price. Instead of having to pay what would normally be about $50,000, probably closer to 55. That's pretty awesome to reduce your property taxes by $40,000. So that was an awesome thing that allowed a lot of homeowners, A, to stay in their home, and B, to move to a new home that either better fit their needs or was more of what they wanted, and not get hit by increasing their property taxes by fivefold. That was Prop 13. Prop 5 is a proposed amendment to Prop 13. Prop 5, let me screw this up. Let me tell you what the state of California says. It says, so you can go to their website, ballotpedia.org California _proposition. I'll include a link at the bottom of the page. California Proposition 5, the property tax transfer initiative, is on the ballot in California as a combined initiated constitutional amendment and state statute on November 6, 2018. A yes vote supports amending Prop 13, which came about in 1978, to allow home buyers who are age 55 or older or severely disabled to transfer their tax assessments with a positive adjustment from their prior home to their new home, no matter A, the new home's market value, or B, the new home's location in the state, or C, the buyer's number of moves. Couple things is mentioned that I forgot to mention here. First off, Prop 13 was county specific. So not all counties in California participated with Prop 13. So for instance, if you were moving from Orange County to, I don't know which counties don't participate, but to another county, it might, you have to double check as to whether or not you could transfer your property tax base accordingly, because not everybody does. Part B is Prop 13 was only usable one time. So if you bought and sold a place at the age of 60 and you decided 10 years later that didn't work for you and you were now 70, you would have to now pay whatever the new property tax was for the new home as though you were a first-time home buyer. Oftentimes that's a major hit to a lot of people, especially as you're going off into retirement and you are trying to reduce your costs, or at least manage them at a minimum. Okay, going back to what this means. A no vote opposes amending Prop 13 to change how tax assessments are transferred between properties for home buyers who are age 55 or older or severely disabled. So basically it just means that we're still with Prop 13 and you maintain that. So basically Prop 5 is suggesting a blend of the property taxes. So they're more or less blending your existing property tax base and slightly increasing it. So for example, the example that we talked about in our meeting, maybe more realistic to this climate. So what they're saying is for an upward adjustment. So for instance, if you were to buy a home that was more expensive than your existing home, they're saying the formula goes as follows. The assessed value of your prior home, so whatever you're selling your current home for, I'm sorry, not that. Assessed value of your prior home. So whatever your tax assessed value for your prior home, or existing home, the home that you're currently in or moving out of. In one segment, parentheses, the new home's market value minus the existing home's market value. So new home cost minus old home's cost at the time of sale. So not when you bought it, when you sold it. That probably makes no sense. So a more concrete example here. The example that we have is somebody sells their home for $1.5. The home had a tax assessed value of $200,000. You buy a new house for $3 million. So the new tax assessed value would be the $200,000, which was the tax assessed value, plus parentheses $3 million minus 1.5 would result in 1.7. So what they're saying is the difference between 3 and 1.5, which is 1.5, plus the 200,000 results in 1.7 million. Again, I'll include a link to that. So this means that more or less your property tax would probably be just south of 20 grand a year, probably closer to 17 grand, somewhere in there, as opposed to 30 grand a year. And that's for somebody who is probably paying close, I mean, if the 200 grand assessed value, it probably means you were paying close to 4 or 5, depending on how long you were in your property, and that 2% year over year on average growth for property taxes. So to go up incrementally is spectacular. So to go, because otherwise it would have been something probably closer to like $5,000 to $30,000. So increasing your property taxes by sixfold normally is a massive hit to a lot of people. And so this does increase it, but minimally, which is nice because oftentimes a lot of people, you know, when they're in their home for almost 30 years or so, unless they've refinanced the loan like crazy, they've typically pretty close to paid down their loan from when they purchased their home, or their home has increased in value so much that the amount of equity that they have in their home is great. So typically at the time of sale, the equity in the home is pretty great. Now, it also works for a downward adjustment. Our downward adjustment math works slightly differently. It's typically less of a concern, but in case it is a concern, also, like we said, you can do this multiple times. We're not 100% sure on how the math works for purchases 2, 3, and 4. For instance, do they use the hypothetical 200,000 tax assessed value to calculate the new property tax for property number 2 after the age of 55, or 3 or 4, or is it blending the most recent purchase? So in this particular scenario, let's just continue with the doubling the home value. So for instance, scenario A, hypothetically, is $200,000, right? Plus parentheses, the difference between $6 million and $3 million, which would get you to 3.2. So would you now be paying $35,000 a year in taxes? Or would it work accordingly? So in our prior example, the new home's tax assessed value was $1.7 million, in which case would this then work as $1.7 million plus parentheses, the difference between the two, $3 million. So now we're being assessed at $4.7 million, in which case you're paying closer to almost $50,000 a year. Not sure. That's a lingering question that we have. So something that needs to be cleared up. So hopefully I'll find that out in the near future here. Anyways, going back to the downward assessment value. So that works in case you are continuing to buy more expensive property. However, if you choose to buy less expensive property, how does this now impact you in comparison to Prop 13? So the downward adjustment formula is the assessed value of their prior home, one segment, multiplied by the difference, multiplied by the new home's market value divided by the prior home's market value. Very complicated to say. So the example that we have is an individual sold his house for $2.5. The house had a tax assessed value of $200,000, and we're using $200,000 as the tax assessed value. Bought a new house for $1.5, so a house for $1 million less, essentially. The tax assessed value of the new house would be the $200,000 multiplied by 1.5 over 2.5. So that would give us a result of $120,000. So ideally, that person is now paying closer to $12,000 a year in property taxes, which again, more, but still less than if it were just out of pocket at the 1.5 rate. Not by a lot, but still a bonus. So the differences are, they're still increased. They're not, in a perfect world, they're not that pain. They're not, the concept of pain is relative. So it's relatively less painful than it would be if it were just Prop 13. However, still more painful than what the prior situation was. But the number of people I know who are reluctant to move because of the massive tax hit that they would take on is a pretty large population. The The other thing too, like I said, is that this is useful throughout all of California. This is not requiring that counties cooperate with one another. So there's no significant homework that you would need to do in case you decide that you want to move to some retirement spot. You're just done and decide that that's the thing for you. There's no stress about having to identify how to navigate these waters. For instance, I have clients now who, are trying to convert their primary residence into an income property because they're concerned about being able to take their property taxes with them, and they're just thinking they can't do it because they're going to have this massive upward push, in which case their property taxes are going to increase significantly. So one of the things that the California website talks about is who's for and who's against this. I think from a mathematical standpoint, it's pretty evident that financially it's a lot less painful in terms of the taxes going out the door. So the pushback would be who benefits from property taxes. Well, schools do. A lot of property taxes go to fund our schools, our local schools. So that's a population that is hypothetically against this. However, my argument to the schools would be that I think the volume of transactions that would occur as a result of this proposition being passed would negate the lost tax revenue. So for instance, if I'm correct in presuming how many people are not moving, empty nesters are not moving as a result of the fear of the significant increase in property taxes and not being able to manage their costs and being forced to then work longer and not enjoy whatever it is that they're moving themselves into. Time will tell as to whether or not that actually is true. But I think there's a lot of, personally for me and from what I see, I think there's a lot of evidence to support that. Especially in, at least in my local market, the range of the $4 to $10 million range, the people who maybe are still pretty cognizant of property taxes, especially a lot of the people who are maybe moving up into that bracket who, have been in their home for 20 to 30 years and are probably paying 10 grand in property taxes to go and add an extra zero to that is a pretty painful thought. And the other thing too is that when you think about property taxes in California in particular, I mean, it's the sum of some people's salaries in other states, very comfortably so. I mean, $10 million property, you're paying $100 grand a year in property taxes. And hands down, six-figure income is a highly attractive offer for a lot of different communities throughout the U.S. So, it's hard for me to think how this would not be good. Again, I understand the teacher's perspective, but if there are pent-up sales that are not occurring because of this fear of the increase, I think the volume of transactions could strongly negate that. So that's Prop 5. Our other one to discuss is Prop 10. Prop 10 is related to rent control. I'm sure there are an awful lot of people who have seen yes on 5, no on 10. Generally, the people who like something like Proposition 5 typically don't like Prop 10. Because what oftentimes happens is that a lot of rent control home building owners, or the stereotype is that they don't bother to fix up the property. And hopefully because of that, the tenants move, in which case they can finally go in and remodel it and clean it up and bring the rents up. So Prop 10 is more or less kind of expanding rent control, but I'll read the specifics related to it. So California Prop 10, the local rent control initiative, is on the ballot in California as an initiated state statute on November 6, 2018, similar to last time. A yes vote supports allowing local governments to adopt rent control, repealing the Costa-Hawkins Rental Housing Act. A no vote opposes the initiative, thus keeping the Costa-Hawkins Rental Housing Act, and would continue to prohibit local governments from enacting rent control on certain buildings. So Prop 10 is an initiated state statute that would repeal Costa-Hawkins Rental Housing Act, thus allowing local governments to adopt rent control ordinance regulations that govern how much landlords can charge tenants for renting apartments and houses. Prop 10 would also state that a local government's rent control ordinance shall not abridge a fair rate of return for landlords. Again, more or less just expanding rent control. The idea behind rent control is that it allows people to manage their costs, not unlike the concept behind Prop 5, but more related to renting. Which I find kind of interesting, this concept of rent control, because again, in a capitalist society, everything's kind of a concept of supply and demand, especially in a market like real estate. I forget what that term is called, but means it's a one-for-one trade. There isn't a price fluctuates based on demand. So, anyways, so the reason I mention that is, to me, this means that if we're considering rent control, it means that we need to increase the amount of available housing. It is an alternative to rent control, because if there's too much inventory, it means that rent prices have to go down. Whereas if there aren't enough places to rent, it means that prices will go up. Supplies diminish, demand increases. And it's funny for me to think about this personally, because I've had a number of tenants who have rooms for rent who have couples inquiring about rooms instead of individuals. So this tells me that more than likely there are a number of people who are, again, making attempts to reduce their costs. So instead of going through rent control, they're going about it in another way in terms of sharing spaces. So like when you hear stories about New York City and 5 people renting a studio apartment or something or other, it's akin to that, shall we say. The tough part is, to some extent, the cities don't always make it super easy to build, and it's not necessarily always cost effective to build multifamily housing. And I know I've heard recently that that's a reducing supply. And the crazy thing to me is there's an awful lot of income property currently in this market. I mean, I understand that there are some people who are on fixed income or what have you. And location is always key. But clearly I have some strong sentiments on rent control. It's hard because it reduces... there's a part of me that, like, in a capitalist society where you've got... You're more or less dependent on well, I guess, I don't want to call it a rat race, but in terms of money flow. So you're dependent on some of this flow to kind of, and then liquidity and things moving and exchanging hands. And as opposed to situations where everybody kind of battens down the hatches and just hangs on to everything they have, and then nobody has any fluctuation, no movement, no mobility. When you have this mobility and growth and movement, typically that's where people find their margins of growth. So, like for instance, in the downturn in 2009, 2010, 2011, you could purchase property, rent at a reasonable price, and the market was comfortably growing. So the homeowners were making money, the tenants typically had reasonable, affordable places to live, and everything was kind of on the upswing. Obviously, that was, at this point, crazy to say, many years ago. But, we're still in that cycle, so not too terribly long ago in the large scheme of things. So it's tough. Like I said, I'll include more links to this. Obviously, I'm a little biased towards Prop 5. I think it could be hugely helpful for an awful lot of people. And continue that mobility. Volume could negate whatever supposed loss these teachers would take on. Hypothetically, of course. I don't have a crystal ball. But yeah, I think these are two really important factors. Obviously, this is probably more relevant if you are a homeowner or looking to become one. Again, these things do change. Sorry if the angle adjusted. Camera dropped. I think I may have turned my head. Anyways, I was saying, so my uncle's an accountant, and I oftentimes talk to him about things and how this impacts everybody from a tax perspective, and me personally, and based on what it is that I'm doing. And he always tells me to not make decisions now, necessarily tax related based on retirement, because like I think about my parents in 1978, they were basically kids. So and they're now north of 55, so now they could partake in Prop 13, but if they had kind of operated their whole lives like that, I don't think it necessarily would have made a whole heck of a lot of sense. But the point is to not make decisions as though they're concrete, because everything's kind of malleable. I personally like to think of things as almost being a little bit like the concept of Pangea. So, when we had theoretically, we were one giant landmass that got separated off into all these different continents. And so, we think of the world as being very concrete, very stable with the arrangement now. But if we think of it in terms of like it's with the lava flow underneath and everything's kind of slowly moving, and that's California again, when we get earthquakes and things, direct visible result of kind of that movement. Can't always make concrete decisions based on some of these items. You can try to do your best to predict and do what you can, but at the end of the day, there isn't one right answer that way. Nor do you always have the expectation of how things will be in the future. That's why you kind of more or less prepare or not prepare accordingly. Anyways, wanted to talk about taxes, propositions coming into voting. I don't always want to make everything so highbrow. This is a pretty highbrow topic for the day. I think next week I want to take it back more to basics, and just some things for people to either understand interest rates or maybe we'll go over credit scores or what have you. But for instance, I was at the dog park today trying to explain to somebody how if your money is just in the bank, you're probably losing money. and trying to portray that to somebody who did not quite understand the conversation was pretty funny. And trying to draw parallels or comparisons was pretty an interesting challenge. The beauty of communication, maybe. Anyways, thanks for watching. Stay tuned next time. Again, my name is Christina Heimstead, talking about money as a tool, and getting a better understanding of more or less what makes this country function the way it does. Stay tuned. Keep watching. See you next week. Thank you.